Real estate investment practice problem using OneNote. Lender credit method 1. Get ready because we're raising the stakes with real estate. We are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab down in the 4220 Lender Credit Method 1 tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below, looking at the lender credit, which can be thought in essence as the opposite of points. Points, which we've talked about in prior presentations. Points being the concept that we put money down up front to purchase the points in exchange for a decrease in the rate, which could result in the payments going down, making it hopefully easier for us to be confident that we can make the payments over the life of the loan and possibly have a net benefit with regards to the APR or the cost over the life of the loan. This time we're looking at the lender credits where we're thinking about the rate actually increasing in exchange for cash flow up front. So in essence, the lender credit is in essence the lender giving us money up front, us money in order to, which will typically be applied for the closing costs, and we do so in exchange to free up the money, most likely so that we can get the deal done. If we need money up front in order to get things done, then we can possibly do that in exchange for an increase in the rate so that the lender is going to be making their money back over the life of the loan, and therefore you would think it would be a beneficial thing to the lender. So note, it's a little bit different than the points situation, because the point situation is most likely in a situation where you have cash flow, you have the cash flow in order to buy the points, and then you're thinking that it might be a net benefit over the life in order to do so and possibly give you some security with the lower payments. On the lender credit side, you possibly have a non-cash flow, a cash flow deficiency to make sure to get things done, and therefore you're willing to pay possibly more over the life of the loan. In other words, you're probably expecting it over the life of the loan to work out possibly as a disadvantage, the lender basically making out through the increase of the rate, but possibly being able to do that or being willing to do that in order to get the money up front in order to close things out would be the general concept of it. So if we look at our data here, we're going to have on the left-hand side, we've got the idea or our starting point, which we're going to have without the lender credit, and then we'll add the lender credit. So we got the home, we've got the loan. We didn't put anything down just so you're just looking at the loan at this point in time. So a loan of $250,000 in essence, years, 30-year loan. We got the months at 360, 30 times 12. The rate we're saying is the starting rate. We're going to start at the 3%. Now, there's a couple ways that you can think about this. Remember, when you're doing comparisons of different loan options, you're always going to have the closing costs that are going to be involved. There's always going to be some closing costs. So you could try to compare the loans and say, hey, look, I would like to compare the rates before considering the closing costs, and then basically say the closing costs are going to be somewhat equal between the two. And if they are, then that might be an easier way to do some comparisons between the loans. Or you could say, okay, well, if the closing costs are going to be different from one loan to the other loan, if one loan has substantially more closing costs than the other, then you'll typically want to roll them into the effective rate, which is kind of like an APR type of calculation, so that you could see that rolled into basically one rate. So the closing costs, that's one concept with regards to the closing costs. So we're talking about an issue with the closing costs in this case. So you could look at this basically and say, I'd like to have the closing costs here just to note them and possibly calculate them as rolled into the rate for an effective rate before we have the lender credit, and then roll them into the effective rate after you take into consideration the closing cost and the lender credit. That's one way you could look at it. We'll take a look at that next time. This time, we're going to say, let's look at it this way. We're going to say this item, we're not going to include the closing costs and just consider the rate with no closing costs, and then consider the closing costs and the lender credit in the second option, or the second option being with the loan, the credit here. So then we have the home value in the second option, the loan 250, 30-year, 360, the rate's still starting at that 3%. And we're saying, okay, what we would like to do, we're able to take on the 0.75 increase in the rate to bring the rate on the loan up to 3.75. Now, these numbers are just basically made up numbers. These numbers could vary depending on your circumstances. So you got to see what might be available to you in that case. This is just for example purposes. We're going to say it goes up by 0.75 in exchange for the $9,000, that we're going to have to say is going towards then the closing costs. So we'll imagine the closing costs are $9,000. The lender's saying, hey, if we increase the rate by 0.75 from 3% to 3.75, we can offer you the lender credit, which will pay off in essence the closing costs in exchange for that increase in the rate, which of course you will pay back to us in the format of basically interest over the life of the loan. So that's going to be kind of the exchange or deal that would be involved. Now, just note there's a couple things to just realize. You might look at this concept and say, okay, what if I'm short on cash over and above the amount of the closing costs? Meaning, what if my closing costs are $9,000, but I need more cash flow upfront to make this happen? So I'm willing to take an even higher rate to get a larger credit, possibly to dip into the 20% down that might be required on the loan. Typically, you can't generally do that, right? So if you're using this strategy, you're typically going to be limited to the amount of the closing costs to get the cash flow to make things happen basically up front. That's going to be the general rule or idea related to it. Now, remember also that this means that the lender credit does not mean that the lender's rolling this into the loan. When we go down to the amortization table, it's still going to be $250,000 in terms of the cost of the loan, the loan amount. It's just that they're going to make their money back in terms of the rate increased from 3% in this case to the 3.75%. So then the next calculation we could say, okay, well, what if we take that into consideration with regards to our effective rate so that we can do a comparison between these two rates? We would expect the effective rate to be higher in this case because the lender's probably going to want a benefit in order to put the cash flow up front and get the benefit over the life of the loan. So we could see that it does come out to 3.464 in this case rather than the effective rate. If we weren't to do that at the 3% effective rate calculated thusly, we got the rate times the number of periods. The number of periods is going to be 360, not times, but first argument number of periods, 360. And then we've got comma. The payment is down here at the 1157.79, which is calculated by the information up top, comma. The present value, and this is where the twist is, it's going to be the $250,000, and then we add the $9,000 of the lender credit that we're receiving. So we got the $250 and the $9,000. This other negative has to do with points. We close that up times 12. That gives us the effective rate of the 3.464, which is greater than the 3% if we didn't have the lender credit. So in essence, the twist here, what's happening is the result of the inflow in period 0. So in period 0, from a cash flow standpoint, on this first argument, we're going to be saying the first loan, we got $250,000. We can imagine it as if we got the money. We got $250 from the lender, and then we use that to pay the seller for the home. Now, of course, we also had the closing costs that we had to pay out up front here as well. And we're going to imagine that's the same in the two scenarios, meaning the closing costs will have to be paid up front in either scenario. The difference being in scenario 2, we got the credit that's going to be paying off the closing costs. So what happened in scenario 2? We got the $250,000 that we used to pay off for the home. And then we also got another $9,000 that we used to pay the closing costs. So in essence, we got $259,000 in scenario 2 versus the $250,000 in scenario 1 in exchange for the increase in the rate in scenario 2. So that's one way you can look at it. Again, in the second option, we'll kind of roll the closing costs. We'll look at the closing costs in each option and look at the effective rate as we roll the closing costs in. But you can see what the difference is in this method, which I think is a little bit easier to see. That, of course, results in a larger effective rate here. So we would expect that to be the case, meaning the lender's going to win out over time as the time passes, meaning they're going to be making interest on the higher rate and have a better, basically effective rate if they have the lender credit, we might be willing to take that on in order to get things done, in order to get the cash flow up front to get it done. The question then being, what's the cost benefit analysis of doing that in order to get it done versus having a situation with no lender credit on the left-hand side. So if we look at our amortization schedules down below, notice we start off with the same amount, $250,000 in each. In other words, the second option over here, it's not like we're basically having that lender credit rolled into the loan. That's not how it's working. It's being paid back with the use of the interest that's going to be changing. Also note that difference, the fact that we have this payment that happened up front, is going to result in that timing difference that happens over time. So when we look at the time value of money concepts, the internal rate of return, you would expect the 3% return here, the way it's been set up, to be in essence equivalent or constant through the life of the loan. Whereas this one, because you have that payment that happened up front, in this case, the lender giving us the money up front, you're going to have a difference in basically what the effective rate would be at every payment throughout the loan. So you have that same kind of problem when you're saying, well, what would happen if we were to change or make an adjustment sometime in the middle of the loan period and then look for kind of like the break-even point for it. So you have that timing type of issue. So down below, we got our two amortizations starting off at the same amount. Then we've got the difference in the payments that are resulting here due to the higher rate for the second one, which is going to result in a difference in the loan balances as we go through the amortization of the loan. They both go through amortization for the 30 years or 360, zeroing out at the end. We could do a similar kind of break-even analysis here. This one not taking into consideration really time value of money, more of a cash flow situation, and it's also somewhat of an estimate because it's not really taking into consideration the ending balance that you have to pay off at the end of the loan amount. But it gives us a good approximation to start to hunt to where that kind of break-even point would be, or at least give us an idea, and we might be able to have enough information for our decision-making purposes from there. So if we take the lender credit, which is $9,000, now this time, unlike the points, we're not giving the $9,000. They gave us $9,000 in essence upfront that we used to pay off the closing costs, which we would have had to pay off whether we got the credit or not. So they basically gave us the $9,000 upfront and then in exchange for the difference in the rate. The difference in the rate, the payments with the credits are now higher at the $1,158 about. It's rounded. If we did not have the credit, we're at the $1,054 about. So the 1,158 minus the 1,054 is a difference of $104 per payment. So if we had a $9,000 that they gave us up front divided by the 104, then it would take 87 payments in order for it basically to even out. So we got the benefit up front, and then you would expect then it would even out and the lender would start basically benefiting after 87 payments. So in this case, we would be benefiting up front, and then after the 87 payments and so on, the lender, you would think, would start to benefit after that point in time. So you have that timing difference in place. If we take that and divide it by 12, we divide it by 12, then that would be at about 7.2 years. But again, that's somewhat of an approximation. So then you can use your IRR tools to try to take into consideration the time value of money and try to figure out what the rates would be in that way. So we could take the information from our amortization table. This is with the credits. Let's take a look at this item here. We've got the $259,000. Just to verify what this actually means, if I take the $259,000, which represents the $250,000 loan that we paid to the seller plus the $9,000 they gave us to pay off the closing costs, and then we took all the outflows, which are the payments that we made, which are going to be the 1,158, looking at the cash flow then all the way down for the 360 time periods, that would have a net total of the 157,804 negative. If we took the IRR, which would be the basically equals IRR of like this whole series of payments, and then times 12 to get the yearly rate, this IRR represents the rate at which this series of cash flow payments would be zero. So that would give us the 3.464. That should be the effective rate that we calculated up top. So if I go up top, in other words, and say, is that what we calculated on the effective rate, which is way, way up here? We got 3.464. So that's going to be just to prove that effective rate that we had calculated. Then we can hunt for that break even. Let's take a look at payment number 87. So if I go down to payment number 87, we're going to go right here. So now we got the same thing, but we cut it off at payment number 87. And then we got to look at the loan balance. Here's kind of the twist. We got to see, well, what would the loan balance be at that point in time? We'd have to go up to our amortization table and say, all right, 87. If I go to the 87 payment, we're going to say it's right there. And we're looking at this one. So we're going to say this is going to be, we'd still have to pay off the 212422 if we were to sell the property at that point. Plus, we'd have the 1158 of the loan balance of the payment. So we pay it off at the end. That's going to be the 213,580 that we'd have right there. And then if we totaled this up, we got the 54,150. And then if we took the IRR of this series of payments, the rate at which that series of payments would result in 0, we get the 3.153. That being different than we got for this item, because again, there's that timing difference with the prepayment that happened in the beginning. If we did the same calculation for the loan that didn't have the lender credit, we would then expect it to be even at the 3%, basically over the whole life of the loan, because we don't have that difference in the payments up front. So we're looking for the point basically at which this IRR would equal 3%. That would be on a time value of money basis, what you would think would be the kind of break-even point in actuality. So it's not quite here at 87. If we go up to like 66, if we hunt around, and so let's do the same thing to like 66, and then we look for that ending balance on 66. And I say, all right, the ending balance on payment number 66 is this amount right here. 66 would be, we'd have to pay off 222,448 plus the 1158. So we'd have to pay off at the end the 223,606 at that point. So that would be right here, the 223,606 about rounded. The total flow would be the 39,862. And if we took the IRR then of this series of payments, the IRR being the rate at which that series of payments would in essence be 0, it would be around that 3%. So that looks a little bit closer to the 3% that we would expect to find if we did the same calculation for the scenario where we didn't have points. Remember, this one was 3%, the starting point. So that would be basically kind of the same kind of break-even type of analysis. Again, the break-even may or may not be as important because really your goal here on this one most likely would be, hey, I got a cash flow shortage up top. I possibly am willing to take on the added amount of the rate in order to get things done. The question being, how much more might that be over time, and what might be my options in terms of maybe refinancing, or if you're thinking about holding the property for a shorter period of time and you're thinking about doing something within that time frame, it could be a significant thing, obviously, to look into, because again, you're getting the benefit basically up front. In that scenario, the bank would win basically as time passes, generally more likely in that scenario, and give the payment basically up front. So same kind of concepts. Next time we'll do a similar kind of calculation. You'll notice here it was a little bit easier for us to figure this side because we can assume that the 3% is basically constant. If you roll in, for example, the closing costs into the effective rate, then you've got that same kind of problem where you got to hunt around that 30%, the rate will kind of change as the loan goes by. So if you can hold one of these rates kind of constant and see what the difference is in one or the other, it could be a little bit easier to hunt around for that break-even internal rate of return calculation. But next time we'll roll in, we'll look at the effective rate over here, and then we'll look at the impact on the effective rate of the credit and the closing costs and look at it in that format.